Hey there, welcome to Nepi Invest. Time for part 5 of my Appendix 4C video series. So in this video series, I go back to the quarterly cash flow reports that companies have released in January 2021. Always find it's a good little gauge to see how companies are doing over the past quarter or so. Now, the other day I did hear someone say, I won't say who, but some experts say you don't really have to look at financial statements because it's all about the future. It's not about the past. And I think that's a blind look at a company because if you don't know where they're coming from, you're going to have no idea where they're heading. So anyway, I do like to look at the past, and even though the share price is sort of a look at the future, you can't ignore the past because you can learn a lot from it. So the three companies I'll be focusing on in this video are companies that I do own for full disclosure purposes, and those three companies are Alexium, Genetic Signatures, and EOS or Electro Optics. So let's get to the first company. And that company is Alexium. Now, when I first started researching Alexium about 7 or 8 years ago, their main focus was on flame retardant material because traditionally flame retardant material has been quite toxic and they wanted to address that. Now, it's been very slow going in regards to getting that flame retardant non-toxic material to the market. So they've sort of shifted focus recently, well, maybe not recently, over the last few years, where their main focus is on phase change material. And that sort of material it's cool to touch. So for instance, if you hop onto a mattress and has phase change material on it or cooling material, then it'll be cool to touch. I have one of those on my mattress. And they do have some contracts in regards to mattresses, bedding, that sort of thing with Certa. So that's where most of the money or most of the revenue is coming through the phase change material sector. Market cap of 39 million. Last financial year, they did have revenue of 9 million. This is in American dollars. Actually, no, it's in Australian dollars. Revenue of 9 million Australian dollars and operating cash flow negative to the tune of 4.6. Now, they have been heading in the right direction when it comes towards operational cash flow positiveness. And the main thing I wanted to see with this quarterly cash flow is, are they still heading in that right direction? So let's have a look at their operating cash flow. So when I look at the Appendix 4C, I always go straight to Section 1, which is the cash flows from operating activities. This is the important section. So I focus initially on the receipts from customers, which is $2.2 million for the quarter. Now, isolation, that really means nothing because I like to look at the trend, and we'll look at the trend in the next slide. But down the bottom there, we do see if the company is operational cash flow positive or negative. And in Alexium's case, for the quarter, they were negative to the tune of only 53,000. So let's call it they were neutral, so not really losing much cash for the quarter in operations. Overall, they did lose $400,000 in cash, and most of that was because of intellectual property costs to the tune of $333,000. So I mentioned before, I do like to look at trends, and this is the cash receipts trend for Alexium. You can see it's all over the place. It's not really the sort of trend I look for. So I look for cash receipts that go from the bottom left to the top right. And we've seen a mountain in this cash receipts, which is not always a good thing. So something's been happening with the business. Now, what's been happening is just a change in management style. So the initial management group back in 2016 and 17 were obsessed with growing revenues over margin. So no matter what sort of margin a customer had, they wanted it. So really low margin, so high revenue, low margin, they were not cash flow positive, even though we saw cash receipts getting to $7 million in one quarter. Change in management style, so change in management groups, saw the new managers be more obsessed with growing high margin business. So even though we've seen significant decreases in the cash receipts, because it's higher margin, they're almost cash flow positive. So I do like that sort of management style. I don't like the low margin businesses because a lot can go wrong with that. Now, since their low point in January 2019, they have been growing cash receipts at a quarterly compound rate at 13.8%, which analyzes around 50% per year. So that's a good thing. And we did see a little bit of a trough back in April and July of this year, and that's just because of COVID-19. Now, I always like to look at a chart of a company no matter what, and an interesting looking chart for Alexium over the past year. In fact, the share price has done nothing. So if you go to the share price 1 year ago, it was 6 cents, The share price right now is 6 cents, but it's done a lot since then. Got to a low of 3 cents back in March during the COVID-19 financial panic. We've seen a few times it breach almost 10 cents, but definitely just over 9 cents twice. The first one was based off some really good news in regards to the main reason I bought in a Phonon technology. That's that clothing that gets cooler the warmer it gets. And then the second one was when Small Cap Website did an article on them or recommended them, and apparently they have a lot of members, and so a lot of members can't think for themselves and jumped on to Alexium, and then we saw a lot of profit taking from current negative shareholders. So still a lot of shareholders who are fairly negative to the business. I do have a look at Hot Copper on forums on occasion, and you can see that negativity still in some of the posts. And why are they negative? Well, this is the 3-year weekly, and this just shows you what's been happening to the share price over the past 3 years. It actually gets worse if you go back even further, look at the 5 years. You can see that in the moving averages. It's just been a downward trend over that time period until we get to the last year, and the share price is now going sideways. And this is what we define as a consolidation base, and that's a good thing moving forward, because if this company can find its inflection point, and hopefully this is the inflection point this quarter because they have almost reached cash flow positiveness, we could see the share price go into a long-term uptrend. It remains to be seen, maybe it won't. And we've also starting to see increasing volume, and that's because some fund managers are getting interested in this company. So the second company I'm going to look at is Genetic Signatures. This is a diagnostics company. Won't say all the rage over the past 9 months or so, but there's a lot of these sort of companies been popping up and doing quite well over that time period, and that's understandably so. Ticker code GSS. They do have a market cap of $274 million, and when you look at the revenue and operating cash flow for the previous financial year, you got to look at that with you shouldn't focus on that because those numbers have changed quite a bit over the last few quarters, and I'll get to that in a second. So if you want to have a further look at the Appendix 4C for GSS, they did release the report on the 21st of January, and I do highly recommend looking at the company's quarterly cash flow report, particularly if you're a shareholder or you're interested in that company. So this is the operating cash flow for Genetic Signatures over the past quarter. Now, happy to say it did make me happy as a shareholder. I did like this quarterly cash flow report, and cash receipts for the quarter were $8.9 million, which is a little bit lower than the previous quarter, but we really did expect that. So the previous quarter they did have $11.4 million. Now the good thing is they are still operational cash flow positive, and for this quarter that number was 4.1. But also want to take note that they did receive $2.6 million in government grants and tax incentives, and typically that's just a one-off. So if you take that away from the overall operating cash flow, they still were operating cash flow positive to the tune of around about $1.6 million. Now they began the quarter with $33.2 million of cash on hand, and finished a little bit higher at 36.3. So unless they do an acquisition, I don't think Genetic Signatures will be doing a capital raising anytime soon. Now this is the receipts history. Of course, I always like to see the trend in receipts, and this is the sort of company where the trend is sort of useless because they've been the beneficiaries of a pandemic around the world, because people are doing more diagnostic testings, that sort of thing. And you can see that with the cash receipts here. Before the COVID-19, they weren't seeing the cash receipts growing all that strong. They were growing, but not strongly. Definitely unlike what we've seen over the past 3 quarters. So we've seen cash receipts going from around or just above $1 million per quarter to over $10 million in one quarter in October 2020. Now the compound quarterly growth rate since April 2015 is around 18%, but I think you just have to ignore that growth rate as well. Now, because I am a shareholder of a company, and this is in my long-term growth portfolio, when you look at the 1-year daily chart, you see a lot of noise. So I will provide a weekly chart in the next slide, but just looking at the 1-year daily chart, we have seen the share price rising during this period. We saw a really good uptrend from late March all the way through to July, where the share price rose from about $1.10 all the way up to nearly $3. Then it's been trending sideways ever since. It looks like the trend, the sentiment is wanting to turn around recently, but I'm thinking of maybe buying a trading parcel in Genetic Signatures if if it develops into an uptrend soon. So keeping a close eye on this one for a potential trading strategy in parcel. But because I am a long-term holder of this company, I like to take away the noise of the daily chart and look at the weekly chart. And when you look at the weekly chart, you can definitely see an uptrend over the past 3 years or so. So all the way from 40 cents to right now $1.92. So a good uptrend here. And right now, even if you're a long-term growth holder, right now is probably a good time to buy. And share price might get to like $1.60, $1.70 before I'd be becoming concerned. But right now, I think it's a good time to buy if you're interested in long-term holding of genetic signatures. Final company I'll be looking at today is EOS, or Electro Optics. Now, this is a long-term holding in my portfolio. I've held this company for quite a few years. They're into space, communications, and defense. I do think this company has a lot of promise for the next decade or so. So more than likely, I'll be holding this for a long time, or hopefully anyway. So market cap of 775 million. So it's definitely grown over the past 5 or 6 years. And if you look at their financials, it's sort of interesting. They did have $183 million in the last financial year, and even though they had a large amount of revenue, they were still operational cash flow negative to the tune of $95 million. So why is that? Well, the old saying is you've got to spend money to make money, and that's sort of the phase or the stage that EOS is in right now. They are spending a lot of money on materials, inventory, that sort of thing, so they are able to fulfill all the contracts they have lined up over the next few years. So more than likely, we're going to see the revenue and the cash receipts grow quite considerably over the next 2 years or so. So how has the company done in the last quarter? And happily enough that I am quite satisfied with this pennies 4C by this company. I thought it could have been worse than what we experienced or what they gave us. Receipts from customers, $36.3 million, which was an all-time high for the company. But even though they did get quite a bit of receipts from customers, they're still operational cash flow negative, and that's to the tune of $3.3 million. And they are still bleeding cash from other parts of the business. For instance, they did spend $7.6 million on capital expenditure. Because of negative exchange rates, they did lose $2.1 million there. So they began their quarter with $79.4 million of cash and finished it with $66 million. So that's a slight concern, a slight cross against the name of EOS. So again, I'd really like to look at the history of the trend of cash receipts. So a really good trend here from EOS. We did see the trend for the first, so this goes back to July 2013. And between 2013 and the beginning of 2018, cash receipts wasn't doing anything. In fact, during that time period, the share price wasn't doing much either. But since the start of 2018, when the share price started to think about rising, we've seen a rapid growth in cash receipts. So if I go back to the beginning of 2013, we've seen the quarterly cash flow or quarterly receipts grow at a quarterly compound rate at 5.4%, and the compound quarterly growth rate of receipts over the past 6 years has been 21%. So analyze, that is around 80% or over 80%, and that's actually quite good growth rates. That's the sort of growth rates you would want for any company you own. So of course, I have to have a look at the charts, and really over the past year, EOS has done nothing. Although at the start of this period, the share price was $10. Now it's around $5, so it's actually halved in price. But you can see what happened with the COVID-19. Share price went from $10 all the way to $3, which would have been a great time to pick up some shares. I did pick up some shares just near the low there, so yay me, I suppose. But over the past 8 or 9 months, the share price has just gone sideways. You can say this is a consolidation base. That's what I'm hoping it is. And once some good news comes into the market, once they become cash flow positive, once those receipts start to really accelerate, I think that's when you're going to see the share price start to really increase. But as a long-term holder of a company, I like to filter out the noise you see in the daily chart and look at the weekly chart. So this is the weekly chart that goes back to 2017. You can see over 2017-18, the share price wasn't doing much, but when those cash receipts started to grow, we also saw the share price growing in 2019. And in fact, the share price went from something like $2.50 all the way to $10 in a fairly short period of time. So it was a four-bagger for a lot of shareholders, including me. I did sell out some at around $10 around the COVID-19 or start of COVID-19 financial panic. We've also seen a fairly large increase in volume over the past year or so. So that's maybe a sign that institutions, fund managers are getting more interested in this company, and also potentially a sign that even the mum and dad investors are getting interested as well. And so that's also something I really like to see, is that increase in volume. So that's all I've got on this Appendix 4C update. 3 companies I've included: EOS, Genetic Signatures, and Alexium. Now, I'm doing these videos just to share some ideas. So just because I'm a holder of these companies doesn't mean you have to think about holding them. Do some follow-up research if something I've said has piqued your interest, that sort of thing. So it's all about sort of maybe giving you some inspiration so you can do some further up research. Now, I'm not a financial advisor. That's why none of this is advice. I'm not a financial advisor. So if you do need some financial advice for your circumstances, make sure you seek out someone who is qualified. That's all for this video. Have a good day. Bye.